You're listening to AI PRISM from Seoul Economic Daily.
It's Tuesday, June 30. Let's look at what this means for retail investors in Korea. Yesterday, the Korean stock market did something that seems, well, mathematically impossible. An incredible 826 out of 946 KOSPI listed stocks rose, yet the index itself still closed down 0.20%.
Yeah, local market analysts are actually calling it an illusion market. I mean, it is the absolute definition of a paradox.
Right, and our mission for this deep dive is to figure out exactly why that illusion exists. We're using data from the Seoul Economic Daily, some recent retail investor surveys, and insights from Europe's DWS group. Basically, we're unpacking the structural stress fractures hidden inside Korean equities.
Exactly. Ultimately, we really want to know what this extreme semiconductor concentration means for your portfolio.
Because to understand why the headline index fell despite such widespread market gains, you just have to look at the sheer scale of foreign capital movement.
Oh, the numbers are wild. Yesterday, foreign investors executed a record net sell-off of 7.76 trillion won.
Which pairs to about, what, 5.5 billion US dollars?
Right, $5.5 billion. And that wasn't a broad market sell-off. It was concentrated almost entirely in just two names, Samsung Electronics and SK Hynix.
Yeah, Samsung fell 4.86% and SK Hynix dropped 1.68%.
And because of their massive year-to-date gains, those two companies now consume an astonishing 50.2% of all KOSPI daily trading volume.
Over 50%. That's insane.
Yeah. I mean, just a year ago, they accounted for only 21%.
Okay, let's unpack this. Imagine the KOSPI is a massive ship, right? And it is being steered entirely by two giant rowers.
Okay, I like that.
If those two rowers suddenly stop and take a break, the boat turns. It really doesn't matter how hard the other 944 passengers are paddling.
Right. If those two rowers stop, the whole market just shifts direction. The sheer weight of those two megacaps overrides everything else. And what makes that top-heavy vulnerability so dangerous right now is the massive disconnect between that structural reality and, well, the current mood of retail investors.
There is definitely a disconnect. A new survey shows 70% of retail investors plan to increase their stock allocations, and they're heavily favoring AI chips.
Right.
A quarter of them even predict the KOSPI will hit 10,000. Add in DWS Group suggesting that Korea's inclusion in the MSCI Developed Market Index is just a matter of time, and you can see why people are feeling so bullish.
But that blind faith in AI is kind of sucking the oxygen out of the rest of the market. KOSDQ trading volume, which represents the smaller tech-heavy domestic stocks, has plummeted 70.5% since its April peak.
Wow, 70%.
Yeah. Everyone is staring at the domestic illusion, but there is a massive structural threat growing right across the sea. China's leading memory chip maker, CXMT, just signed a massive supply deal with Tencent for server DRAM.
Those are the essential commodity memory chips used in data centers, right?
Exactly. And that deal is worth 4.5 trillion won, or about 3.2 billion US dollars. Plus, to fund their expansion, CXMT is targeting a 6.7 trillion won, around 4.8 billion US dollar IPO on the Shanghai Star Market.
Wait, specifically to double their wafer capacity? Yes.
So wait, they aren't just securing domestic contracts to supply Chinese tech giants. They are building a massive war chest to double production and potentially flood the global market with cheaper chips.
Yeah, that is the structural risk almost nobody is talking about.
Are retail investors just so blinded by the AI hype that they aren't pricing in China's domestic chip substitution undercutting Korean pricing power?
I mean, it really looks that way. If CXMT doubles its output, it creates a very real mechanism for a global supply glut. China's self-sufficiency drive isn't just a political talking point anymore. It is gaining real commercial traction.
Right.
And for Korea, having half the market volume tied up in two chip makers creates a severe single point of failure if those global supply dynamics shift.
So what does this all mean for you, the listener? If you hold Korean equities, especially through broad global ETFs like EWY or FLTR, the KOSPI's daily move is a really poor proxy for your actual portfolio right now.
Oh, absolutely. Because of that illusion market, if your exposure leans toward mid-cap names, you likely outperformed the headline index yesterday. Yeah, you really have to look beneath that headline number. And going forward, there are two major catalysts to watch.
Right. First is the July 1st KOSDQ 30th anniversary reform measures.
What are we looking for there?
Well, the government might announce stronger delisting rules for underperforming companies. That could positively re-rate those smaller and mid-cap names by cleaning out the deadweight.
Okay, That makes sense. And the second catalyst.
The July and August hyperscaler earnings calls. Updates from companies like Microsoft, Google, Meta, and Amazon regarding their data center capital expenditure.
Because those spending budgets are the single most important forward indicators for Samsung and SK Hynix earnings.
Exactly. They basically dictate global AI spending.
Which brings us to a final thought to leave you with, and this ties right back to that ship with the two giant rowers.
Yeah.
If Korea's market direction relies almost entirely on two chip makers supplying global tech giants, are you actually diversifying geographically by holding a broad Korean index fund, or are you just secretly doubling down on Silicon Valley's data center budget?
You've been listening to AI PRISM from Seoul Economic Daily.